Hi everybody, I'm Mike Gasior, and welcome to my January video commentary. And as I mentioned in this month's newsletter, I was going to take a little bit different approach this year with these commentaries. Rather than just being a ramble as it sort of was last year, each month I'm going to make it almost like a mini seminar touching on different financial and market topics. This month, I promised, was going to be Economics 101. And, I'm an economist by nature and I'm an economist by training. And I almost get offended when I hear people refer to economics as the dismal science. Because quite frankly, ever since I was a little kid, I always loved money. I mean, I gave a speech in Las Vegas last year to an investor group. And I don't know whether it was the city that I was in that caused me to say it, but I actually just sort of blurted out, I love money. And, damn near got a standing ovation from that crowd. But I didn't mean it in sort of the shallow way that most people mean it, that they'd like to have a lot of it. Not that that wouldn't be swell. I meant it in just ever since I understood how the bank worked or how they print it, or when I learned about the Federal Reserve. I mean, I find the whole thing fascinating, and it gets kind of a bum rap. Now, obviously, I've only got a few minutes, so this has to be fairly concise, and as articulate as I can make it. But let's just start with this. Most modern economists, myself included, subscribe to what's known as the friction theory of economics, which is a simple premise that in any economy, at any moment in time, there's a certain amount of money that people are willing to spend on stuff, and there's a certain amount of stuff and services that are available to be bought. The simple premise of this friction theory is if you increase the amount of money that people are willing to spend, well, obviously that's going to drive up the price of the stuff. And what that is simply is inflation. And in every economy, inflation is the enemy of that economy's currency. In the United States, you almost don't hear the word inflation used without Alan Greenspan's name being in the sentence along with it. And most Americans and most people around the world don't really understand what Alan Greenspan and what central bankers do. In most of the industrial economies, there's a system similar to the U.S.'s Federal Reserve System. In Japan, it's the Central Bank of Japan. In Europe now, it's a European Central Bank. There used to be the Bundesbank in Germany. Then you have the Bank of England in Britain. But they serve the same role. Long ago, the politicians, oddly, had the wisdom to separate who controls the money supply moving out of the hands of the politicians to these central bankers. Now, even too many Americans think Alan Greenspan works for the Federal Reserve. That's not true. Well, he works for the Federal Reserve, but the Federal Reserve isn't part of the United States government. There's the confusion. He's appointed, Greenspan and whoever the chair of the Federal Reserve is, by the U.S. president, serves a 4-year term, is confirmed by the U.S. Senate. But the Federal Reserve itself is actually a privately owned corporation that operates as a government-sponsored enterprise. And once Greenspan's confirmed, it's a very non-political position because the U.S. Treasury prints the money. Greenspan and the Federal Reserve decides how much of it is out in the economy at any given time. The two responsibilities given to the Federal Reserve by the U.S. government was to maintain the integrity and solvency of the U.S. banking system and to maintain the value and the integrity of the U.S. dollar. And like I just said, the value of any currency is the most important thing in that relative economy. And if Greenspan and the Federal Reserve senses that the economy is growing too fast, and from the School of Economics that Greenspan's from, the Keynesian school, the fastest the economy can grow without there being inflation is about 2%. Anything faster than that growth-wise can be deemed inflationary. So if he senses that it's growing too fast, the way they control that and slow the economy down is through interest rates. The Federal Reserve sets an overnight lending rate that the banks and the Federal Reserve use to lend each other money short term. So when statistics start to roll in, sometimes they don't make any sense to Main Street because the statistics that sometimes upsets the Federal Reserve seem to be good news. Retail spending is up, housing starts are up, or, ooh, God forbid, unemployment falls. Because outwardly, those seem like all good news. But retail spending, housing starts, and of course, when unemployment's low, employers are going to have to pay more money to keep or attract employees. All of those might be symptoms that people have more money that they're willing to spend. And don't get confused, because in school you might have studied some economics and might remember M1, M2, M3. Those are simply measures of the money supply, which is not what I said. We're talking there how much money there is. I'm talking how much money people are willing to spend. Because remember, Americans especially are horrible borrowers. They borrow way too much money. You know, I could go to Best Buy and see that high definition plasma TV I've been thinking of getting. I don't need to have the $5,000 on me. I could use plastic. So if the Federal Reserve senses that this stuff is a symptom that the economy is growing too fast, they'll start to raise rates in an effort to discourage that kind of spending. Maybe I'll think twice about getting that plasma TV. Maybe somebody will think twice about going to Sears, getting a new refrigerator, and so on, or buying a new house. So they'll start jacking rates up, which is exactly the situation we've been in for the last 9 or 10 months. The Federal Reserve has been tightening, which means raising interest rates in an effort to slow the economy down. Now, that's just the opposite of the stand that they took back in 2001, which was historic. The only time in history the Federal Reserve lowered interest rates 11 times. 7 of those were before September 11th. And the word I got to bring into the conversation now is recession. The technical definition of a recession is 2 or more consecutive quarters in any economy where either the economy does not grow or, worse than that, shrinks. When it's a capitalistic for-profit economy like US, Japan, Britain, Germany, France, and so on, these economies are vastly driven by consumer spending. And when consumers stop spending for whatever reason, sales for these corporations begin to plummet. But, you know, the example I often use is Ford Motor Company. Ford is a for-profit company. They're going to stay profitable, damn it. And if their sales start to go down, the first expense they get rid of is employees. So if Ford lays off 20,000 people, well, immediately now there's 20,000 people who can no longer buy Ford Escorts. And the trouble is you can get into this death spiral. As sales start to go down, profits start to drop, and it's difficult sometimes to pull out of that. So what the Federal Reserve or the central banks will do then is start dropping rates in an effort to stimulate the economy. You know, maybe I'll go now to Best Buy, charge that plasma TV. Somebody will get a new house, charge that new refrigerator or whatever. It's a very important job. And what I wrote about in the newsletter too is Greenspan's term ends in January 2006. We're only a year away from that. It's going to be very, very interesting to see who George Bush appoints to that job. For all the angst and turmoil and worry about who George Bush might appoint to the Supreme Court, the job that probably affects most Americans' daily lives is Greenspan's, not decisions made by the Supreme Court. So anyway, that's in essence what, you know, the economics is all about. And politicians will sometimes try to do an end run around Greenspan. And we saw that in the last few years with Bush and Congress cutting taxes. It's another way to stimulate the economy. Because the tendency will be for people, when they have more disposable income, to spend it. Stimulates the economy. And as much as the bond market hangs most closely on what Greenspan has to say, all markets are affected. Stock market, real estate market, bond market. And we're going to get to those markets in upcoming commentaries like these. But, you know, no matter what market, no matter what investment you're interested in following, it's important to have a vivid and clear understanding of what Greenspan's role is and how it's going to affect the market that's interesting to you. So that's this month's commentary. It's good to be back. I hope you enjoyed this serene setting. It's one of my favorite places on my property. The stream, I come here and I sit all the time. But I just wanted to wish you a happy, good new year. It's good to see you all again. And, you know, we should remember, as much as we can, to try to be nice to people who are different than we are. You know, people who have different beliefs, who dress strangely, who talk funny. You know what I'm talking about. I'm talking about people from Jersey. No, I'm just kidding. I'm sorry. Anyway, you guys all take care. I'll see you here next month. Hope you're all well. And next month, stocks, the stock market, stock indexes. Take care.